Today I'm going to do a deep dive into 5 different dividend stocks as I work on rotating out of my growth portfolio into dividend companies in my journey into retirement. So stick around, it should be a great video. Hello my YouTube friends, my name is Adam Cotton and this is Investing with Adam K. I'm also actually working on a new channel the same time called Dividend Retirement, which goes in line with what I'm actually doing. I'm slowly working on rotating out of growth stocks into dividend paying stocks as I try to get to a point where I can live off the dividend being provided in my set it and forget it account. So I hope you guys enjoy the journey as I do this. Now, as always, nothing I share in this video is financial advice. Please, I am not a financial advisor. Don't listen to me, and I really recommend anyone on YouTube for that matter when making financial decisions. You really need to do your own research, potentially reach out to a professional financial advisor when making your investment decisions. So, with the help of ChatGPT, Gemini, and E-Trade, I'm going to do a deep dive into 6 different stocks, including Vail Resorts, which is ticker symbol, I'll still do my errors, I promise. Ticker symbol MTN, Conagra Brands, which the ticker is CAG. I'm going to do a comparison to it with Kraft Heinz, the ticker being KHC. Not because I was going to plan to dive into that too much, but I really wanted to compare Conagra to something else in its field, along with Vici Properties and SL Green. And then the last one I'm going to get to is Starbucks, which I know I mentioned in the live the other day, partly because I feel like Starbucks, all the negativity, like people are kind of forgetting about and not paying attention to, which I think creates an opportunity where it could have some upside. So stick around. Should be a good video. I hope you guys enjoy it and make some comments if there's anything you do. You do not need to sign up. You do not need to hit the like button. I hope you just listen in and I provide some information that you find enjoyable. So I'll start with the first one, which is Vail Resorts, ticker symbol MTN. So MTN currently owns 42 different ski resorts, including Beaver Creek, Breckenridge, Crested Butte, Hunter Mountain in New York, which I'm familiar with because I grew up in New York, Park City, which I've been to, Whistler out in Canada, and of course Vail, among others. They're also involved in not just skiing, but hotels, lodging, condominiums, golf courses, and restaurants. So they are not just ski resorts, which I think gives them a little bit of a diversity, gets them out there. It's a little bit more of a real estate play, which of course I'm going to be talking about REITs later on, but this one's a little bit different. The stock has recently been under a lot of pressure due to a lack of snow this winter, which I think this caused a real opportunity. While it's caused a large decline in sales, I see it as an opportunity since nobody can predict the weather, and this is something that I'm sure they've been through before, and it's something they're going to go through again in the future. And I'm sure it just ebbs and flows with the natural business. So while Wall Street is super concerned that this year there's a lack of snow, which has decreased their sales, well, come on, nobody can predict the weather. I'm sure that that's part of their business model, that some years are better than others, and it shouldn't be a big deal once we move along. And I'm looking for long-term investments, and currently Vail's paying an incredible dividend, which is attracting me to it. Now, getting into some of the financials, thanks to ChatGPT, net income guidance is between 200 and 275 million approximately. The resort expected EBITDA guidance of like 840 to 900 million. And they've had some declines, but they've also been able to raise prices, which have offset this to create a nice balanced, smooth income that they expect for 2026 guidance. So thanks to ChatGPT, I'm going to discuss some of the things they talk about, key risks and challenges, weather and volatility for visitation. So recent seasons have seen weak snowfall, particularly in the western US, which is where their big resorts are. I mean, I know they have Whistler in Canada, but like Hunter, while it's big for New York, really isn't so big, and they've got some smaller ones around. But it's reduced skier visits by approximately 20%, which is pretty significant season to date, which I think it's as of today. It's pressured revenue from lift ticket sales, dining, and ski school, but future snow behavior is unpredictable, which is why I say, like, this is going to be short lived. Nobody can predict the weather. And maybe this whole year is rough, which is okay if you're in it for the long term. It then talks about demand sensitivity. Consumer discretion segments like travel and leisure are also sensitive to the economic conditions. So we're a little concerned about some inflation and things of that nature when there's a little bit of unclarity going forward with what's going on with the economy. So declines in skier visits and pass sales reflect both weather and consumer behavior shifts. Now, I think skiing's gotten relatively expensive. Like my son started snowboarding, but the reality is, even when I was a kid, skiing was an exceptionally expensive sport. So I don't think that's really changed. I do think that the inflation is hurting everybody, but they have real pricing power considering they've got Park City and Vail and all these other places. And when I'm guessing that they push prices through, their competitors might actually match and change their pricing as well. Now, two other things to be concerned about to talk about the negative side of things is they do have high fixed costs and they have taken on some substantial long term debt. So they have some things that they have to get past. They also are in a very competitive industry, which means it's not so simple. I still love the company, and I think it's kind of a fun type of investment to own Vail. I know that sounds stupid, but with my son snowboarding, it's something to put out there. And keep in mind, again, not financial advice. I don't put so much into any of these one individual companies. I spread out into a bunch to kind of create like my own version of an ETF in case I pick a really bad one at one point and it goes the wrong way. That it's okay to have one or two that aren't working the way you hope, because what you hope is your overall portfolio is doing just fine. I had a long conversation with my buddy about this morning, who we'll talk about Conagra later, but he was complaining about both Conagra and Kraft Heinz, how they've been struggling so much, which is part of why I'm doing the deep dive in them. And my answer to him was, as long as you have it spread out in a balanced, diversified portfolio, you're going to have ones that are underperforming. And you hope over a 5 year period or 10-year period, they catch themselves and they have some up times as well. The companies like this may have long term in his mind of a year or two where they really struggle, but that may not be anything that indicates underlying problems in the company. Now, I'll talk about Conagra and Kraft when we get to that and go into it a little bit more. But either way, just know that when I talk about MTN, I don't love it so much that I am just plowing a huge amount of money. I just like the dividend that it's paying. It's something for me to be able to add a tiny bit into as I rotate out of the growth stuff into dividend payers because it pays a nice dividend. Now, we'll get to that and some of the other risks and the good thing, which is they do use a good amount of their cash flow to be paying that dividend. So you kind of have to keep an eye if they have a few seasons that are really rough that they may end up having to cut the dividend. But hopefully that's not the case because right now I think it's like somewhere around a 6% yield, which is unbelievable. Now, for the bullish case, first of all, they have a great brand. They have good ski resorts with good names that have good flow of traffic, so to speak. They also get recurring revenue from something called an Epic Pass, which I think automatically just lets people renew and renew year after year and probably gives them some discounted prices. I'll have to look into that a bit. They also have strategic cost effectiveness, meaning because they're so enmeshed into so many different resorts, they have a good feel for the market, able to price properly and make changes where they need to, and they have good liquidity with ongoing capital returns. So I see that as some really good things going on that make me comfortable to put something into it. So either way, at least I'm comfortable with the risks of owning Vail Resorts. I like the company. Like I said, it's kind of a fun way for me to be invested in that space. And I think with this pullback, as the stock's gotten down below around $140 a share, I see that as a good opportunity. I do think that it being the rough weather is not that big a deal and something that the company is used to. So the next stock I want to take a deep look at is Conagra, ticker symbol CAG. Well, I really like Conagra, and the main reason is they're making enough money to pay a pretty high dividend, paying 8% currently. And if I can get an 8% return, even if the stock doesn't grow, that's fantastic for what I'm looking to do. Now, keep in mind, Conagra is facing some headwinds and some things going on. Their earnings have dropped considerably, which is why the stock is under so much pressure. And a lot of people really hate it, which puts it in the line. And when I talk about Target, as much as I'm joking, I kind of like when stocks are hated because that gets put into the pricing. And part of why it's pushed down so much isn't just the inherent risk that's going on with it. And there is some risk with Conagra, but also that negative sentiment puts added pressure onto the stock valuation. And to me, that means you're getting it at a discounted price, which is kind of what I'm looking for, especially if I'm looking to own something for a long term. Now, if you're only owning it for a short amount of time and you're one of those people that gets in and out of things, things that are out of popularity or have negative sentiment are really going to affect your ability to have those profits that you're hoping for in a short time frame. Now, before I get into the actual financials and go into how Conagra looks to me, I'm going to read a quick conclusion that ChatGPT provided, because these are the things I kind of look at when I'm evaluating a stock. So, Conagra Brands, CAG, is best characterized as a value dividend-oriented defensive consumer stock rather than a growth leader. Its high dividend yield and defensive product portfolio provide appeal for income, which is exactly what I'm looking at as I'm trying to rotate into something for my retirement journey. So it's high dividend yield and blah, 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 income-focused investors, but near-term fundamentals are challenged by inflation, tariffs, and declining sales trends. Analysis consensus is generally neutral hold, and valuation reflects both the risk and income potential. Investors should consider, 1, their tolerance for high dividend risk, given the payout ratios on the upper end of the comfort level. So what they're showing in ChatGPT is they're using about 75 to 80% of their free cash flow to be able to pay the dividend. I'm good with that. As long as it doesn't push over 100, I'm totally fine with that because I'm happy to get that dividend. Now, currently, when I get into the financials, since they showed a bit of a loss, you actually don't even see that. It shows like they can't afford it and that they don't have a PE. But though there were some expenses they took on their taxes to make it look that way, and they're actually making plenty of money to be able to pay the dividend, which is what I like about Conagra. Of course, that could change. So number 2 that they mentioned, the company's ability to counter margin pressure through pricing and cost management. And this is one of their concerns. And the broader sector trends and consumer preferences towards healthier premium products. Now, I don't think that's really true. From what I read in an article, one of the concerns and one of the things going on are companies like Walmart and Amazon are doing reverse engineering to try to mimic some of the products that companies like Conagra and even Kraft Heinz, which I'll go into next, are having on their shelves and giving them less shelf space to push their own brands. So they're pushing more of the great value brand in Walmart and giving less space to Conagra, which is impacting their sales. Now, I don't picture that being forever. It could be a bit of a long-term trend, and maybe they try to squeeze them more and more, but I think there's enough demand for Conagra products that they still carry it, they still say it, and the earnings are going to catch themselves and maybe even start to drift higher. And I don't think they're going to lose a whole lot more shelf space because, quite honestly, I don't know that everybody loves having the great value brands, and people are pretty, what's the word I'm looking for, loyal to the brands that they really like. And Conagra has a good list of brands. The only one that I can remember that like pops out in my head is, I want to say Slim Jim, I think Orville Redenbacher, but there were a whole bunch that you'd recognize if I went through the list. The other thing that I really like by it being defensive is what I notice in my account is when the Metas and Amazons and Googles are just raging higher, Conagra is having a tough time. But on the days when the market is getting beat up pretty good is sometimes when Conagra is doing well. And that tends to balance things out a bit. Like, I've said in other videos, at this stage in my life, it is not my goal for my account to outperform the markets or even do as well as them. I want to have some protection in there as well. And even though Conagra has a good amount of risk because what they're going through specifically to Conagra, they also balance out because of the defensiveness of they tend to do the opposite of what the high flyers are doing. So that gives me a little bit of comfort in how the account portfolio overall tends to do. Again, it tends to underperform on big up days. So those of you who really want to do the best you can and make as much as you can, maybe it's not the right fit for you. And again, not financial advice. Anyway, let's go through the financials real quick and see what's going on. Um, Institutionally owned, about 87%. There's 6% short interest float, which I don't love. That's getting a little high for a company like Conagra. They're currently at an 8% dividend, which I'm thrilled about. Um, Earnings per share, this is why I said it throws off all the data because it's not really accurate. It's showing negative 20 cents, but that's not really what it is. They had some expenses that they put onto their earnings that make it look that way. They actually beat expectations when they announced last quarter. The stock then started out higher and it slowly reversed. And it looked like it had a nice bottom recently, a little bit below $16 a share. Inventory turnover 3.87. Yeah, because here, effective tax rate 1,910%. So, kind of my point. They took on a big tax thing that makes it look like their earnings were worse than they are. Price to sales 0.74 and price to book 1.03. I think that that's a better thing to look at since we don't really have PE. And that looks pretty attractive to me. It seems just fine. Profitability, again, they're showing a negative 1.81 net margins, but that's not really true. Gross margins being 24.57%. And I'll see when I take a closer look at Kraft Heinz. I'm guessing that's just fine for the industry. Again, I don't mind taking the risk of Kraft Heinz to try to get that extra high dividend. Not putting a ton of money in it because I recognize that the ones that I'm talking about have some risk today. But I think it's worth it for the account that I'm trying to build. That if they get through these things, that I'll be really happy that I took the chance while they were giving a good payout. That maybe it becomes a nice reward on a small investment at current prices. So the next stock that I wanted to dive into, mainly to compare to Conagra, because I hadn't done it for myself, and I already have a small position in it. I also, for disclosure, have a position in Conagra. But both of them, again, I keep them small because I know there's risks with these companies, is Kraft Heinz, ticker symbol KHC. Now, I'm going to run straight to the valuations that ChatGPT is sharing with me and real quickly go over that they're in the same position. They show a negative profit for last year, so they don't really have a PE, but that is for expenses. Now, they're also going through a restructure of the company. I think they're separating Kraft from Heinz, and you're going to end up having two companies, but it may take a little bit of time. I'd have to take a look to see when that's going to go through. But similarly, now their margins seem to be a little bit better at 33.75 for gross margins, but showing a net profit of negative 17%, which I know isn't really accurate. So ChatGPT shows that they have a forward PE of approximately 9.9 or just under 10, which is super low. And one of the things that really attracts me to these companies, price to free cash flow between 8 and 12%, which is also quite low. The price to sales is 1.1, 1.14. So these valuations suggest the stock trades at a discounted value, which again, that's the stuff I love. When these things are out of favor is what I like. And sometimes all the negative comments and everybody's hate on this stuff ends up working to your favor. Now, there is legitimate risk. There are problems with these companies, which is why they are discounted. But for me personally, to take a small percentage of my portfolio and spread it out amongst the things that are out of favor, I think if I wait 5 years and buy things at discounted prices, eventually things work themselves out. Like I have this saying of like, bad news, good companies. And generally, good companies are names that you know, good brands. Things like Target. There's nothing wrong with the company, and I don't mean to harp on it, I don't mean to do it. But part of why I do that is everybody seems to hate them. But they've been around a long time and lots of people shop there and they make plenty of money. So while everybody hates on it, you have to take a second and look at the earnings and recognize that that causes the price to be discounted. And what's that old saying that Wall Street is the only place that when things go on sale, everybody runs for the door? It's really true. When things have negative sentiment and the price goes on sale, everybody hates it and gets scared. Well, I don't know. There's risk in investing. I'm okay with the risk. You need to do your own research and not listen to me. I'm just talking it through because I do it for myself. So the annual dividend is about 1.60. Let me take a quick look and see what that is as a percentage on the stock, because I know, again, that was something that I was attracted to. So yeah, Kraft is paying about a 6.5% yield. So when you see a company start paying out more than a 4% dividend, is when you really, in my mind, need to start paying attention to what's going on. And if they have some underlying problems where that dividend is now in jeopardy, or are things just fine? Like I start to get worried over 4%. So the fact that I'm showing you two companies with exceptionally high dividends now, not necessarily for like REITs and oil, like midstream companies that we're going to talk about, but for some of these like regular companies that have earnings and give out a percentage of their profits, I'd be a little cautious once that dividend starts pushing a high amount, because they have to be making enough money to make that payment. And these are struggling companies right now with some things that are unclear, which is what Wall Street hates about them. Now, before I go into Hess Midstream and talk about the analytics and what I think of it, the last thing about Kraft Heinz is sometimes, if executed really well, the split can be really valuable. What you'll end up is getting two really good companies that were having struggles when they were combined as one stock ticker. Now, I'm not saying that is what will happen, but that's kind of what I'm hoping for, that when they finally get through that process of separating, that things ease up and the valuations do really well. And maybe it does terrible. I guess we'll see. Hess Midstream, or HESM, for those of you looking for the ticker symbol, through ChatGPT, owns and operates midstream energy infrastructure primarily in the Bakken and Three Forks shale regions. Core operations include natural gas gathering and compression, crude oil gathering systems, produced water gathering and disposal, processing and storage facilities, and terminaling. I don't even know what that is. Terminaling? Oh, terminaling. So I guess they must have a terminal where they put things, and export infrastructure. So Hess Midstream provides fee-based services to Hess Corporation, which is now part of Chevron, and third-party customers under long-term contracts, which supports predictable cash flows, which sounds awesome to me. Now, when I looked at their financials, to skip ahead a bit, they are using 98% of their free cash flow to pay out their dividend. But to be fair, for these midstream companies, they tend to do that. Most of their profits do go out as dividends. And we'll talk about it when I look at the financials, but they're growing at a really rapid pace, which is actually really impressive for a company where in the space they're at. Generally, they just make what they make with these long-term contracts that they have. It goes up at a slow pace, but they start at a high dividend yield, which is super attractive, and tend not to grow very quickly. What I like about Hess Midstream is I think you do have a chance that it could grow at a good pace. Not financial advice, as always. So the downside with Hess Midstream, based on what I was reading, primarily through ChatGPT, E-Trade, and Wikipedia, was that they might be a little bit limited because they work out of that Bakken region, which has a limited amount of shale and product for them to be able to grow. But I also think with the partnership with Chevron, now that they bought them out or bought out Hess, is that it gives them a good customer base that's going to have this long demand, because I'm quite sure they bought them because they need the product. So here are the things that they say about investor considerations. Income-oriented investors seeking high yield, relatively stable yields in energy infrastructure, which is me. I'm looking for high yields that are relatively safe and hopefully don't have big problems in the future. And I think oil is going to be around for a while, despite our beginning to bring in nuclear and electric vehicles and everything else. It's not like oil is going to become something that we just don't need anytime soon. So value investors attracted to modest valuation multiples and potential upside from analyst targets, which again, I'm not looking for huge upside potential. If things can go up a little bit or raise a dividend each year, that would be awesome because it's already got a really high dividend. It fits my goal of rotating out of growth into dividends. And longer term holders willing to weather the storm and deal with ups and downs and things that don't move a whole lot in the cyclicality of the oil business. It's less suitable for short term traders and investors sensitive to leverage risk because they take on leverage to do what they're doing. Now, directly from ChatGPT, the conclusion on Hess Midstream. Hess Midstream presents a strong yield and stable fee-based cash flow profile suitable for income-oriented and value investors. Growth prospects are moderate and linked to the regional production trends and contract volumes, while leverage and sector cyclicality warrant consideration. Overall, HESM, they didn't write out Hess Midstream, dividend and valuation make it a compelling within the midstream energy space, but investors should balance yield appeal and industry and balance sheet risk. Meaning, do your own research, the same as I always say. Don't make any financial decisions based on what I suggest. They're covering their butt here in ChatGPT. So let's take a look at some of the numbers here. So their current dividend yield is 8.6%, which, like I said, that's super attractive for me. But I'd be careful. They're using 98% of their free cash flow or their payout ratio, which is exorbitantly high, which means any little bump in the road and they're going to have to lower that dividend. Um, let's see, anything at earnings per share, 2.814. Valuation, price to earnings ratio is 12.4. More important when you're looking at these midstreams is price to cash flow and price to book. Price to cash flow is very attractive in my mind at 7.78. And Hess Midstream PE ratio, again, I think the price to cash flow makes more sense anyway, is lower than 69% of its companies in that space. It means people are willing to pay a little bit less, but I also think it makes it a little bit more secure. Return on assets, 16%. Return on equity, almost 60%, just below. Let's see, net profit margins are 42%, which looks super attractive to me. Anyway, I really like Hess Midstream. It's another one that fits into my category. I do not own it currently, but what I've been doing for those who are curious is any of the growth stocks that I have, either I put an offer above the market where if it gets to it, I'll sell some shares and then rotate it into the dividend payers. Or if I have enough shares, I might sell a call to create some income and also pick a price where I'm willing to sell the company. And if I get taken on those calls, that's the money that I'm going to use to rotate into these things as I move out of the other things. The stuff I'm doing it on are the biggest positions in my portfolio, things like Meta and Amazon and Google. And I love all of these companies. I have nothing against them. But fortunately, I bought them at really good valuations and at a really good time. It's become a little bit big of a position for the portfolio that I need. And maybe it's time to kind of spread it out a bit. And I'm looking for things that are a little bit pay a dividend, maybe a little bit more boring, and maybe we can do something to have some passive income coming in. So I'm going to zoom through the next two and tell you why I picked them and what's going on. They're both REITs, and it's Vici Properties, VICI, and SL Green Realty, which is SLG for the ticker symbol. I picked them both because they have unique things going on right now that I think is making the stock price really attractive. For Vici Properties, which is primarily based in Las Vegas real estate, the news about how Las Vegas is dying and traffic is terrible and everything else is causing some weight on the stock valuation. And I don't think it has anything to do with the reality of the company. Basically, they have contracts with the casinos out here where the casinos pay them monthly no matter how the casinos are doing. So even if the casinos aren't doing that well, they're still going to pay their rents. They're not looking to go anywhere. These contracts also have increases every year automatically or every so often, depending on the terms of the agreement. So they're going to be able to increase what they charge the casinos. So I don't really see that changing. The other thing is while that has made great headlines and everybody loves to see how Vegas is failing, as somebody who lives out here, the casinos are doing just fine. Maybe things are a little bit off from previous years, but they are busy as can be. When I go down there, my God, I went to the Wynn to play poker for the first time in like years, and you had to wait an exceptionally long time to get a seat. So I don't see them really struggling the way the news makes it out to be. And maybe on some random Tuesday, somewhere might be slow. I also think that the prices have gone through the roof, so it's very easy to say it's gotten so expensive that people can't afford it. But I will tell you that doesn't mean it's as slow as the media is making it out to be, which tells me Vegas is going to be here a long time, and Vici Properties is going to continue to collect those rents from those big casinos also for a long time, making it more secure than what the media is making it out to be. Now, maybe I'm wrong. I mean, I'm willing to admit that, but I think that's create a weight on the stock that's just unrealistic. So similarly, SL Green has similar types of things going on, but they are New York based for the most part. And what do they have going on? They have Mamdani, who everybody's panicked over, but underlying are New York office buildings, which are rented out and doing well, and the values of those rents seem to be going up despite the stock price going down because everybody's scared to death of what Mindani is going to do with real estate in New York. At the end of the day, it is real estate in New York. I don't think he's really going to do all the things that he says he's going to. I think it'll be very difficult, and I don't think he's going to crush the real estate market. In the meantime, people who want to rent office space in New York are going to come to a company like SL Green. And I'm guessing that they're going to be able to continue to drive their revenues in order to be able to pay those dividends that they do as a REIT. So I see the price being depressed as really good opportunity. And if I'm wrong, I'm wrong. Again, I don't put so much into one stock that I'm super concerned about any individual holding. If I spread out amongst a bunch of them, some will do well, some won't. I don't worry about it too much. Anyway, like I said, I just wanted to breeze through those because those are the reasons that I think the valuations are attractive. I think with Mamdani being in New York, it's pushed SL Green down pretty good. And I think the media about Las Vegas and that it's dying has pushed down Vici Properties. And I think both of those have created a really attractive time to potentially invest in these. And last but not least, Starbucks. And really not least in my opinion, because Starbucks has had a lot of negativity going on for years. And full disclosure, I own it from like $113 a share. It's why I say I own these things for extremely long periods, and nothing has changed in my mind about Starbucks, so I really don't worry about it. I didn't worry about it when it was trading in the 70s and the news was talking about how profits were doing terribly because it's only one portion of my portfolio. And as far as I was concerned, it is a perfect company to compare to my McDonald's story because they're a big, boring company, just like McDonald's was when I bought it in the 1988 or whatever it was. And I'm hoping to own Starbucks for 30 or 40 years. And I think they're well enmeshed in the drink space and what they call the energy drink space at this point, even though I think they're just a coffee shop. They've built a great brand, and I don't really see them going anywhere. And during all that negativity, they've taken on a new CEO, Brian Niccol, who was the guy who turned Chipotle into Chipotle. So I think he's going to do a great job. I have a ton of faith in him. And I think all of that I hate Starbucks stuff finally totally forgotten about. And anybody who's been holding it for a really long time has probably given up by now. And I think it gives room for it to move to the upside. So, ChatGPT. Starbucks is the world's largest coffee house chain, operating thousands of stores globally. Its revenue is generally primarily through company or operated stores and licensing, and with significant contributions from retail packaged beverage and grocery channel products, which I think we all know who Starbucks is. Excuse me. I'm not going to edit. I'm not going to pause. I'm only going to spend so much time doing this stuff. Starbucks has built a brand recognition with a loyal program which historically supported pricing power, premium positioning in the retail coffee sector. Now, I'm really interested to see what Brian Niccol does, because one of the things he did at Chipotle is he simplified the process. There aren't a zillion things to choose from. I think one of the weaknesses at Starbucks is it's just too much. And I think that makes it hard on the employees. I don't mean for the consumer or the customer, but I think you want to simplify things so that the employee can get things done more efficiently and quicker and easier and doesn't have to memorize 600,000 things. I think it's probably just a little bit overwhelming for some of them. I guess we'll see, though. I mean, it's a different business and probably harder to do because the person who wants their, low-fat, almond milk only flavored whatever it is, it's hard to just get rid of that product and get rid of those customers unless they've done an analysis that those customers may not be worth it. Again, part of what I love about Starbucks is it had so much negative going on. Everybody hated it. It seems like the bottom is finally in. I actually, as much as I was long from where I was, I have added on a little bit in the 80s. If it goes back down there, I will continue to add on. I think that they've stretched what their payout ratio was for their dividend. But let's take a look and see what's going on in the financials currently. Again, I have faith in Brian Niccol. So dividend yield 2.66, and yeah, it's showing a payout ratio of 150%, which I don't think that's really accurate, but I do think it's in the high 90s. And let's see, PE looks high, but everything else looks okay. I mean, again, I like the brand. I like there's negative news weighing on it. Bad news, good companies, and let's go to the conclusion in ChatGPT. Starbucks is at a turning point. I agree with that. I think they've gone through a rough period. But if your time horizon is 10 years, your companies are going to have rough periods. So it's okay. When I tell the story of McDonald's, understand it fell in half multiple times from 1988 until today. There were plenty of downturns. At one point, they had mad cow disease. And I'm sure if I was older and analyzing the stock, that was a scary period. The stock was getting pummeled. They were talking about it in the news. I just think if these companies are going to be around a long time, they work through that stuff. So the recent stabilization in same-store sales and strategic store investments are positive signs, but profitability remains pressured and near-term execution is uncertain. Starbucks may appeal to investors with longer horizon and confidence in the turnaround strategy, while more risk-averse investors may prefer to see consistent earnings improvements before committing, which is totally reasonable. So it's just a matter of if it fits you, it fits me, so I'm okay with it. I'm not super concerned either way. What I'm comfortable about is they'll figure it out, and maybe they'll go through a really rough patch. Maybe they'll have to close down a bunch of stores to really focus on the ones that are the most profitable, or maybe not. I guess we'll see. Anyway, like I always say, or what I've started saying, no need to hit that subscribe button. No need to hit that like button. If you want to, go right ahead. Just do me a favor. I hope you enjoy the content. let me know if there's anything you want me to look at or any stocks you're eyeing that I'm happy to look at, especially if they're dividends, because I'll be happy to take a deeper look to see if it fits what I'm looking for. Tuesday, I will do my best to do another live. This weekend is my wife's birthday, so I don't know what's going to happen, and we have a long weekend, and we got snowboarding and all sorts of things going on, so maybe I will. But as always, the time sucks for most of you, but that's because I'm super selfish. And, like I said, I do this for entertainment purposes only. So if I don't make it to do one, well, I shrug my shoulders. I am going to try to post this on the new channel that I'm starting. I don't really know why I am. I just know that something with the algorithm has been giving it a tough time for this channel. I shouldn't care. It shouldn't bother me. But I figure I'll post on both and see how things go. The thing is, somebody called it throttling. When I've done something on another YouTube, it's like it takes a day and a half to upload. So I may not stay, we'll see. Anyway, again, have a great day. Have a great weekend if I don't talk to you this weekend. Um, I'll talk to you guys soon. Bye-bye.